You have heard this conversation, maybe in your office, maybe at a family dinner. Maybe you have had it yourself. Someone pulls out their phone and opens a stock chart. They traced a shape on the screen with their finger. A dip, a recovery, another dip. See this. Every time it falls to this level, it bounces back. 4 times in a row. I am putting in 3 lakhs. Everyone nods. The logic feels clean. The pattern is right there, visible to anyone who cares to look. 3 months later, the stock is down 35%. No bounce. The pattern, so obvious on a phone screen, turned out to be a coincidence with a good story attached. So what went wrong? The stock didn't betray him. His brain did. And his brain was doing the exact thing it was built to do. The thing it has been doing for 200,000 years. Finding patterns. Anywhere. In anything. As fast as possible. In the jungle, that instinct kept people alive. In the market, it quietly drains portfolios. And it does it with complete, convincing confidence every single time. That's what this episode is about. And it's the third piece of a puzzle we started building in. The brain that panics during a crash, the ancestor who was wired to buy high and sell low, and now the pattern finder who sees order in randomness and bets money on what he sees. Here's the thing to hold before we go any further. Pattern recognition is not a flaw. It is one of the most sophisticated tools the human brain ever developed. For nearly all of human history, the ability to find patterns fast was the difference between eating and being eaten, between surviving a season and not. The bush that rustled before a predator appeared remembered it. The season when the river flooded marked the warning signs. The plant that preceded illness never touched it again. Patterns were data. Fast pattern reading was survival, and the brain that found patterns, even in incomplete information, even where none existed, was the brain most likely to be cautious enough to live another day. That brain got selected, reinforced, passed down. You are the descendant of the pattern finders. Every human alive today is. The problem is that a market chart is not a forest floor, and the confident feeling that you have spotted a real pattern, that feeling is identical whether the pattern is genuine or imaginary. That's why this Article 3. The lizard brain tells you to flee, the ancestral brain tells you to buy high, and the pattern finding brain gives both of them a chart to point out and call evidence. Let me tell you something your grandmother probably did, or her mother did. Maybe someone in your own family still does. A crow lands on the wire outside the window. That evening, relatives arrive unexpectedly. It happens again. Crow on the wire, guests at the door. A pattern is born. The crow predicts visitors. The brain locks it in. Did the crow cause the guests? Of course not. But two events happened close together more than once. The brain connected them. And here's the critical part. The brain did not go back and check the 1,000 mornings when a crow sat on the wire and no one came. It remembered the hits, it forgot the misses. Because the hits felt meaningful, this is not superstition. This is the exact same cognitive machinery you are using when you look at a candlestick chart. There are two names for what's happening. The first is apopnea, the tendency to perceive meaningful connections between unrelated things. The second is the availability heuristic, the tendency to judge probability based on how easily a memory comes into mind. Put them together in a market context and you get something expensive. You see a formation. You remember that it worked before. The memory is vivid. You feel certain. You invest. The market does not care what you remember. Here is what most articles on this topic miss. It's not just the brain that finds patterns. It's that the brain generates certainty about those patterns. A feeling of knowing. That is neurologically indistinguishable from genuine insight. The same neural reward circuits that fire when you correctly identify a real pattern also fire when you identify a false one. Your brain doesn't distinguish between the two. It just knows, I found something, and it rewards the finding. This is why pattern-based investing feels so different from gambling. Gambling feels like chance. Pattern reading feels like skill. The emotional signature is completely different, even when the underlying irreliability is not. And there's a second layer. Once you identified a pattern and invested in it, something called confirmation bias activates. Your brain starts filtering incoming information, amplifying data that confirms the pattern, dismissing data that contradicts it. You don't just find the pattern once, your brain keeps defending it. Now bring this into a real market movement. Markets fall, you check your chart, you see a level that held 4 times before, your brain says, this is the bounce point. The certainty is immediate, warm, and completely convincing. The question your brain does not ask, and the question that separates investors who build wealth from those who just feel like they are, is why did the pattern hold before? And are those conditions still in place? Let's make this real. January 2008. The Sensex is near 21,000. Over the 3 years before, 2005, 6, 7, anyone who bought every dip had made money. Every single time. 4 bounces, clear pattern, complete conviction. A 38-year-old investor in Ahmedabad, let's call him Mahesh, had watched this happen 4 times with his own money. He wasn't speculating. He was reading what felt like a reliable signal. In early 2008, when the market fell roughly 10% from its peak, Mahesh recognized the pattern. He moved 8 lakh rupees from a fixed deposit into equity funds. The Sensex did not bounce. It fell to 8,000. His 8 lakh became 3 lakhs. Here is what matters about those earlier 4 bounces. They happened for a reason. Easy global liquidity, strong domestic growth, foreign money flowing freely into Indian markets. The pattern wasn't wrong. It had a cause. But that cause had quietly disappeared before Mahesh made his move. He was right about the pattern. He was wrong about whether the conditions that created it still existed. This is the gap most investors never learn to look into. The pattern looks the same from the outside. The environment that produced it does not. 5 lakh rupees of real wealth lost to a pattern that felt certain because it had been real, just not right then, not anymore. This isn't just Mahesh's story. Run through any period of Indian market history where a pattern broke and you will find the same structure underneath. The pattern held while a specific set of conditions held. Those conditions changed: rates, global flows, sentiments, credit availability. The pattern didn't get the memo. IPOs that always listed at a premium until retail FOMO peaked and cooled. Mid-caps that always recovered fast after corrections until the rate cycle turned. Markets that always bounced before elections, 4 data points, not a law. Every time the pattern felt real. Every time the investor could point into historical evidence. Every time the underlying conditions were the variable nobody checked. The pattern was the surface. The conditions were the story. So what does the investor who understands this actually do differently? The answer isn't to ignore patterns. Pattern recognition, disciplined and tested, is one of the few genuine edges available to a serious long-term investor. The difference is in what you do with the pattern once you see it. Think of it like this. A doctor who notices a cluster of symptoms doesn't immediately start treatment. The pattern tells her which tests to run. The tests tell her what to do. The pattern is the prompt, not the prescription. The same logic applies here. When you see a formation, a level that has held, a sector that has recovered consistently, a valuation band that has historically attracted buyers, treat it as a question, not an answer. The question is, why did this pattern hold? What were the macro conditions? What was the credit environment? What was the investor sentiment? And what was the earning cycle doing? If you can answer those questions, and if those conditions are broadly still in place, the pattern has something behind it. It deserves a closer look. If you can't answer those questions, if the pattern is just a shape on a screen that worked before, that's not a thesis. That's a feeling wearing a chart as a costume. The investors who have consistently used pattern reading as an edge weren't reading screens and drawing shapes. They were reading the logic of the situation. Earning cycles, credit conditions, valuation levels, sentiment, and recognizing those conditions had historically produced certain outcomes. That's structured pattern reading. The screen tracing version is available to everyone. The structured version takes work, and that gap between the two is where most real returns quietly live. Before you act on any pattern you think you have spotted, run 3 questions. First, do I know why this pattern held in the past? Not what it looks like, but what economic or business conditions made it happen. Second, are those conditions still present today? Not approximately, specifically. Rates, flows, earnings, directions, and sentiment. Third, am I remembering this pattern worked more easily than the times it didn't? Be honest. The brain will give you the wins first. Ask it for the losses. If you can't answer the first two confidently, the pattern is a prompt to investigate, not a reason to invest. The market will still be there in a week. There's more practical rule worth building. Keep a pattern log. Every time you act on what looks like a pattern, write down your thesis for why it should hold. What conditions you are counting on. What would prove you wrong. When you review it later, whether the trade worked or not, you are not just scoring the outcome, you are building a testable database of your own pattern quality. That log is the single most effective way to separate the patterns that have genuine structural regions from the ones your brain manufactured because it was looking for certainty. 2 times is not a pattern, it is a coincidence. 3 times might be coincidence. The question is always, what caused it? Your brain is a pattern finding machine. That is not a weakness. It is an extraordinary feature, one that kept your ancestors alive for 200,000 years. The problem is not the feature. The problem is running it without the one-layer evolution never installed. A framework for testing whether the pattern you found is real. Seeing the pattern is instinct. Understanding why it exists is skill. Knowing the difference between the two, that's what separates investors who build wealth from those who just feel like they are. In the next episode, we go to another place. The biological brain causes serious damage in the markets. The instinct to follow the crowd, why it exists, what it costs, and how to think clearly when every signal around you is telling you to move with the herd. Given that we are all wired to find patterns, real and imaginary alike, how do we invest with genuine evidence instead of confident instinct? That's the question this series keeps answering. See you in the next one.